Hi, everyone. Thank you so much for joining me. I'm Jonathan Mills Patrick. Welcome to another episode of Funding Simplify, where I simplify the business funding process, whether that's working with lenders and getting loans or taking on debt to fund your growth, or whether you are working with investors and giving up equity in your startup or existing company. This week, I've been talking all about the various aspects of lending. On Monday, we talked about how long it takes to get a loan. On Wednesday, we talked about the difference between term sheets and commitment letters. And today, I want to talk to you about how rates are set and how you can negotiate a better rate for yourself. What you need to know about how rates are set is that most lenders don't just use a matrix that says you want this much money, we're going to give you this rate. But they do use something called a risk grade, and that risk grade is how they evaluate you, your business, and the loan that you're asking for. It's made up of a variety of factors. Oftentimes they take into account your cash flow ratio, any collateral you're giving, your credit score, and various other factors, and they come up with a risk grade. Usually that's on a numeric scale, so 1 through 10 is what I've often seen, with a 3 or 4 being about the average. A 1 is often an amazing loan, 2 pretty strong, 3 okay, 4 average, 5 starting to get near the line of not wanting to approve it, and usually 6 and beyond is something that they're just not willing to do. So a 3 or 4 is kind of an average on most lenders' risk grades that I've seen, and those risk grades are then used to match against rates and figure out what they can and can't offer you. Now, the thing to understand about this is that lenders then use that risk grade and they pair it up against their index that they're basing their rate on. So an index can be things like the Wall Street Journal prime rate, which is currently at 4.75%. Another index could be LIBOR, L-I-B-O-R, which is a London-based index. It's an interbank index. And they could be using treasury bill rates as their index. And what they do is they'll take that index and then they add a margin on top of it to figure out what your rate's going to be. And that margin often comes based on your risk grade. So if you had a very strong risk grade, they wouldn't add as much margin. If you had a weaker risk grade, they would add more margin. And that margin probably is going to fluctuate somewhere between 1 to 4% on top of the index. So let's do an example. Let's say that your lender is using the Wall Street Journal prime rate as their index. Again, that's currently today at 4.75%. If that's their base rate, and then let's say that you had an average risk grade of a 4, which is not too bad, and let's say with a 4, their matrix does now say that they're going to add 3% to that loan to get your rate. You'd be sitting at 7.75% interest rate. Now, one of the ways you can negotiate a better rate is to understand that that is how the process works. You can ask questions like, what is the index that you base your rates on? What do your margins look like when you add that risk grade evaluation into it? And the reason that matters is it's not often that you're going to see 5, 6, 7, 8% margins on top of the index. It's just not competitive for most banks. But you can use that to your advantage. If you have a sense that the average margin added on top of a loan is anywhere between 2 and 4%, and they're using the Wall Street Journal prime rate, if you're looking at 4.75% as your foundation and they're adding 2 to 4%, you're looking at a range of 6.75 to 8.75. If they come back with 11% interest rate, you need to ask why and figure out what's going on. That could help you negotiate a better rate if you let them know that you have at least a base knowledge of how these things are done. The more likely way to negotiate a better rate for yourself is to ask if they offer a relationship discount. Most banks and credit unions that are looking to also hold deposits on hand will give you a discount for having a deeper relationship with them. That discount can often look like about 0.25%, so 0.25% off of your loan rate every single year that you have a main depository account with them. 0.25% or point, we call it, may not sound like a lot, but it adds up over time. Even on $100,000 loan, that is only $250. But if you have a 10-year loan and you're saving $250 just because you offered to put deposits with that lender, then you're going to save $2,500 over the life of the loan. So it does start to add up. So 2 main ways that you can negotiate a better rate is understanding risk grades and understanding indexes and margins of how lenders base their rate. But the easiest way to do it is just offer to deepen your relationship with them. I've even seen some lenders that will go as far as half a percent or even a full percent off for various relationship items with that lender, like a debit card and another loan and all kinds of different things that they'll add a discount for. So use that to your advantage when you're talking to a lender. Negotiate a better rate and save yourself some money. Hope this information helps you. Take care.